Good morning, and welcome to all of those here with us at the Atlantic Council and all of those watching around the world. I'm Josh Lipsky, the Senior Director of the Atlantic Council's GeoEcon Center, and I am so pleased to be able to stand this morning with our partners at Rhodium Group to launch the 2022 China Pathfinder Annual Scorecard. Now, when the Atlantic Council and Rhodium Group first embarked on the China Pathfinder project, we believed that policymakers in both East and West would benefit from creating a shared language on China's economy. Now, what we did not foresee was how urgently that language would be needed. In the 1 year since we published the inaugural China Pathfinder scorecard, the Chinese property sector, so fundamental to the growth of the world's second largest economy, has been shaken. The party's zero COVID policy is putting enormous strain on the economic system. And foreign companies, as well as governments, are worried about their investments in the Chinese market. Now, a year ago, the question we asked in this report was whether sustained 6% economic growth was no longer realistic. And now we are asking a much different question about China's economic trajectory. What a difference a year can make. Now, that is true for China, as well as the rest of the world. Now, when we started this project, and we are in year 2 of a 4-year project, our goal was to design China Pathfinder as a multi-year to track the progression or regression of the Chinese economy over time and compare it to the world's largest open market economies. And while it is true that the study of the other largest economies was never the primary objective of our work, this new research, released today, pinpoints when other economies, including the US, also start moving away from open market norms. So today, we get to show you the data and analysis that can help make sense of a tumultuous year. From the war in Ukraine to the ongoing pandemic, there are forces weighing on China's economy which the leadership can only partly influence. And it can be difficult to parse out which dynamics are cyclical and which are a product of crisis response. But we believe this report helps deliver an important answer. Many problems in the Chinese economy are systemic and cannot be fixed easily or with simple policy changes. And so we should recognize a new reality. This is not the Chinese economy of the past decade. This shift presents challenges and enormous risks for Beijing, Washington, London, Brussels, Tokyo, and beyond. It also presents an opportunity to move away from the past policy decisions of previous years and approach economies as they stand, not as we imagine them. And that is why the mission of creating a shared language on China's economy, one that is credible both in China and in the United States, is more important than ever. I want to thank the dedicated teams from the Atlantic Council and Rhodium Group that have led this research, as well as our guests from China and the US and around the world who are here and whose presence speaks to the ambition of the project. But before we get to our panel and our guest, let's get to the data. So, I am very pleased to be joined by Dan Rosen, partner of Rhodium Group and senior fellow with us at the Atlantic Council GeoEcon Center. Dan, we're back here again a year later, and I'm going to start with the foundational question of China Pathfinder. What is the problem we are trying to answer with the China Pathfinder project?
Josh, it's great to be here today and doing this again. The origin behind Pathfinder, what we're trying to do here is this, that the global notion of engagement with China as the big organizing principle of our time was predicated from early on, decades and decades ago, on an understanding that China intended a journey toward a market orientation. Market economy status was China's ambition, not just our ambition for China. And because of that, we really need a way to evaluate where China is in that journey, whether we still have an adequate demonstration of direction, of travel for China toward market economy norms.
So, we've teed it up. Here it is, the dashboard, China 2022 Annual Scorecard. Folks can follow along, chinapathfinder.org, as we present this. So Dan, before we get into basically the 6 measurements here, I think it's helpful to orient people. What does it mean to be on one side of the scale or the other side of a scale in this dashboard overview picture?
What it means to be a market economy, pretty complicated matter. We have, as you note, simplified it down into 6 dimensions, which we're going to get into in a second. And the axes that we are looking at here are from a state orientation, statism as a way of dealing with the basic challenges of running an economy, to purely market-oriented ways of doing that. For example, in terms of the financial system, the question is whether you're just letting savers and people who need to borrow meet each other in a marketplace, figure out what the price of credit and money should be, or whether you're having the state play a larger role in that financial intermediation. And on the state side, on the left of each of our axes, you see what a state orientation looks like in terms of dealing with that challenge. And over here on the far right is what a purely market approach to that, as we have come to understand it over the past 70 or so years, looks like.
And as we'll discuss, there's a range of market approaches. As you can see here, these dots represent the top 10 largest open market economies, and then you see this average line, this yellow line, but open market doesn't just mean one thing, even across the large advanced economies.
That's exactly right. I mean, we're interested in China's journey, but to help it make sense to us, we're putting it in relation to the 10 largest advanced market economies in the world, as measured by the OECD community of countries. And yeah, the first and very important thing to note is that nobody is asking where China is against some simple absolute standard of what marketization looks like. One size does not fit all when it comes to being a market economy. There's a range of different degrees of marketization, if you will, and we're looking at where China stands compared to that whole range, not just the most advanced country in any of those dimensions.
So let's get into it. First, financial system development, and we focus first on these internal factors more to the Chinese economy. We look at where China was in 2010, progress now, China today, but very little movement if we think where China was a year ago in this study.
Yeah, I mean, so the financial system, the first three elements we're looking at here are essentially domestic elements of what it means to be a market. The second three, as we'll see in a moment, are more on the external side and interacting with the world. But nothing is more fundamental than how the financial system works to intermediate capital inside the Chinese system. And in that dimension, we see one of the least amounts of movement over the past decade. A little bit of directionally correct travel for China from 2010 to today. But when you use the tools in Pathfinder here to look at what happened 2021 data over 2020 data, virtually no movement in finance whatsoever. That really shouldn't surprise us. This wasn't going to be the year that China had a financial big bang. After all, there's more stress in the financial system than there has been in perhaps ever, given the situation the property sector is in. And so that sort of more conservative stance toward reform doesn't surprise me. On the other hand, and we'll see this when we get to portfolio investment at the bottom as well, that is where the most work needs to be done to get China on a solid market orientation.
And just as we think of some comparative measures here, so if we wanted to look first, Italy, here the closest to China, and then the US further towards the open market consensus. UK was first last year, switched places with the US, but again, a lot of data fluctuation here year to year, so you don't want to overinterpret that shift.
Yeah, a little bit of one year on year change in rank here or movement for any of these countries is not going to be a big surprise to us. What's most important is seeing where the biggest gaps are, where the least gap is between China's system today and what's typical in advanced market economies.
So then we go to market competition, and here, somewhat similar story to financial system. Progress since 2010, but almost essentially no movement over the past year.
Market competition is a complicated dimension. It asks the question, how much do companies compete with one another? How concentrated is the market? How do things, find their level in the system? Is it the market or state intervention that determines that? And this is a really interesting element. While China did not see very much movement 2021 data over 2020 data, which means that it's not really progressing very much in terms of market competition, there has, over the past decade, been a considerable amount of movement away from the most sort of unbridled competition mindset in the advanced economies. And so we actually have seen the gap for China with the advanced economies close in a significant way over the past decade. This is an innovation this year. In the previous first year, we didn't have the ability to look at this movement within the advanced economies as well as China. Now we do, and we start to see a more complicated story, which begs the question, why is the West, if we can call it that, starting to travel a little bit to the left-hand side
and
here?
Folks can explore that on their own. They can drop down to 2010 here for each country and see. But Dan, just to put a fine point on it, are we essentially talking about increase in industrial policies and the Western economies, largest advanced economies?
Maybe. It's early days to say whether this is going to be a persistent trend in the market economy world of sort of, rediscovering industrial policy as an element of statecraft. We have, in the case of the CHIPS Act, some major moves in the U.S. just in the past year, started to see that kind of thing happening. However, that's not going to be explaining this trend over the past decade yet.
Right.
More likely, we're looking at some increase in market concentration in the United States, for example, especially in technology platform sectors. There's a lot of debate and discussion about market power and market concentration.
So this is something we can look at now. We study China's economy, but it's a relative exercise. It's relative to what the other largest economies in the world are doing, and now we have that data for folks to see. Let's go to modern innovation system, which is a bit of a different story, not so much because of China, their growth is, their movement is somewhat similar from 2010, but where the rest of the countries we study are in this survey.
Yeah, innovation, how do you grapple with innovation methodologically? It's a tricky one. We put a tremendous amount of weight and emphasis on how attractive an economy, a nation is to venture capital investors, which is such an important multiplier, accelerant of innovation activity, and looked at in terms of that ability to attract venture capital, these sorts of things. R&D as a share of GDP. China does really very well. It's pretty competitive. The gap is very modest between where China scores and where the advanced economy average score is here in Pathfinder. And indeed, last year, China was in last place among these 11. And now, in just 1 year's time, China is ahead of 3 of the OECD economies we look at. We've got Italy, Spain, and I believe Canada in the mix there that are showing up slightly behind where China is. Now, again, I don't think we should put too fine a point on these very modest differences in score, but when we look at the sort of big picture here and what it tells us that China is already within the OECD range of what is normal in terms of market orientation when it comes to innovation and technology.
And which is a good segue to trade, because speaking about OECD range, on trade, China is closest to where the OECD average is than anywhere else, and the most open market-oriented score of anything else in the China Pathfinder project.
Yeah, absolutely, Josh. And while there's caveats in all these, and there's caveats in innovation, we're going to get to caveats in trade here in a second, the headline story is that China is on the cusp of being at or ahead of the advanced economy average in terms of trade marketization. China is very, very narrow gap here for where China is. Tremendous amount of movement versus even 2010. So, you have to give China credit when it comes to trade for making an extraordinary amount of headwind toward being market-oriented, being more open. But, this is a good one to dig into, I think, because there are some really important caveats to explore underneath that headline story.
Yeah, and so what I'm doing now is I'm clicking on trade. You can do this for any of the 6 that are on there, and you can see how we get this top-line score. So you can see the composites that go into it. So this will indicate why China is doing so well on the good side.
Yep. For each of these 6 dimensions, the team developed over a long course of collaborative work together, Rhodium and Atlantic Council, chose the right indicators that we thought reasonable people of economic bent would agree would be good proxies for how we think about market orientation versus state orientation. And in trade, the first element is goods trade, products, things you can hold in your hand or put on a ship. And looking at China's degree of openness and trade globally, relative to the size of its GDP. And in this dimension, China is ahead of the pack, far and away the most dynamic, largest global trader in goods.
Comparing it to other countries here.
Comparing it to any other country, you'll find China leading the way in terms of global goods trade openness.
But there's a big but and an important caveat, and that's when we get
Several.
down, yes, to services trade and digital trade.
Yeah. So really, it's a mirror image there. While when it comes to goods trade, China is very much at the front of the pack, absolutely wearing the yellow jersey, if you will, if this were a bike race. When we look at services trade openness, such the opposite picture that we get. Rather than being in the leading place, China is in last place. And not only in last place, but decidedly in last place. China is not really very open yet for services trade relative to advanced economies. And that's both, really notable difference and distinction. But when you think about it, where marginal creation of value added is in the world economy today, services is pretty important relative to traditional goods.
And so is digital, the final metric we'll look at.
And so is digital. When we look at China as a digital trade player, it's really not even out of the starting gates yet. Such a small position. Now, everyone has a lot of new questions and debates about how we want to regulate and think about digital trade. Personal data comes along with that. A lot of stuff to be talked about. But the bottom line is that being open to global interaction in digital trade activity is going to be an important part of being a leading economy in the future. And so those are some very big caveats and question marks that hang over this otherwise very bright picture of China having closed the gap in terms of its position vis-a-vis the advanced economies.
Okay, so final two we're going to look at before we turn to our panel: direct investment openness and portfolio investment openness. Some of the most interesting findings in the study, both because of where China sits and some of the regression from 2010 to now.
Right. Investment is really the high-octane fuel of the global economy today. And we're looking at two different dimensions here. And just for listeners who are not familiar, direct investment refers to companies crossing a border to, say, build a factory. It's a very tangible kind of investing to establish a presence in another economy in order to serve that market, that economy from within its borders. Portfolio investment, Josh, is when you call your broker and tell her to purchase for you some stocks and bonds on the other side of the border.
I don't do it that frequently, but thank you, Dave.
Very good. In our line of work, it's better to be pretty hands-off in terms of that sort of stuff, indeed. But so portfolio flows are a sort of passive kind of money crossing the border. Direct investment is companies and multinationals crossing the border.
Right.
Both of them we think of as really important themes for China's economic development. And yet, when we look at what the indicators are telling us here, uniquely among the 6 dimensions, in direct investment, China has actually slipped back a little bit versus 2010. That is essentially saying that in 2010, China was slightly more market-oriented in terms of how cross-border direct investment is regulated versus where we are today. And that is an area where, it begs the question, do Chinese leaders think that foreign firms have less to offer or a less important part of China's journey today? Or what? How to explain this? There's a lot of debate and discussion among multinationals presently of whether this is still the China opportunity they thought it was previously. So this is very important that we see where China chooses to go in terms of direct investment. The kinds of indicators we're looking at here are restrictiveness, right. Whether there's a wider and wider openness to allowing foreign firms to come in on commercial terms and operate in the economy. And then the biggest gap of all is found at the bottom of Pathfinder here, Josh, in terms of portfolio investment openness. China's lowest score, the largest gap versus the advanced economy average, hasn't moved virtually at all since 2010. Tremendous amount of talk nowadays about China being included in global investment indices. and just how large the flow of global capital into China could be, that's all true. And the fact that China's at such an early starting point in terms of moving toward a more market approach means that there's a huge amount of low-hanging fruit here.
And you've done studies of this at Rhodium Group.
We have, and it's very easy to foresee multiple trillions of dollars of cross-border portfolio investment flow in a fairly short period of time. All the large global asset managers have as much as said that they'd very much like to take those positions, make those investments, but it is contingent on China choosing to catch up to and complete a number of basic portfolio openness reforms, without which it's very difficult to close this gap. So, it's every country has to decide how much it's ready for the challenges of lowering its capital account barriers. Even the IMF doesn't have quite as much conviction about the right sequencing and the risks of doing this. But for any country that isn't content to just stay in a dollar-dominated world, it's something that kind of has to be done. If you're not willing to do that, then you have to kind of accept the incumbent financial leaders that are out there.
Okay, well, I think that's actually a good note to end on and transition to our panel. Thank you, Dan. Everyone can explore this on chinapathfinder.org. Let's go over to the panel. So I am really pleased, and as I said at the beginning, the idea behind this project is to bring together East and West, and that's what we have with us today to discuss the data that we just unpacked. So I'll introduce our panel. Nargiza Salidjanova, Director, China Projects Team at Rhodium Group. Dean Yao Yang, National School of Development, Peking University. Thank you for being with us and staying up late in Beijing. And Sofia Horta, Costa, Chief China Markets Correspondent at Bloomberg. Sofia, I know you just came from Hong Kong a few days ago, so thank you for being with us here. So Nargiza, I'm going to start with you. You led this research, you led this project, and the first question I had going over the rough draft of report several months ago is, how do you collect accurate data in the midst of a pandemic when there's so much noise and it's so hard to tell what is just happening in immediate crisis response, what is structural? I'm really curious just foundationally how you and the team approach that problem, and then we're going to get into some of the findings.
Well, thank you for that question. It's a really important one because it really goes to the core of what we're trying to do here, to showcase trends and developments in a situation of crisis and disruption around the world. And it's really a huge credit to the research team in pulling together and identifying the best ways for us to continue collecting this data, keeping it accessible, keeping it very transparent. We made a couple of choices this year for China Pathfinder, which are sort of a bit different from last year in order to enhance our ability to do this kind of analysis. So the first thing we did, as you and Dan already discussed, is we added the 2010 baseline for all of the OECD economies in our sample. And this is for several reasons, not least because in a global crisis, as we're still experiencing that, right, economies tend to kind of respond in similar ways. Sometimes you see the state come in and interact a bit more. So we really wanted to see how the OECD economies did compared to their 2010 baseline, as well as China, because that seemed sort of only a fair thing to do. Another important consideration was sort of the quality and the robustness of data. And as we know, all of our lives got disrupted, and so were the lives of many people collecting valuable information. So some of the indices we were using got discontinued, actually, right? And so we had to go back and really identify how could we highlight developments and sort of enhance what we've been collecting. And we've added several new indicators that really help us underscore the extent to which things have shifted between 2010, 2020, and then 2020 and 2021. And another really important development and sort of where China Pathfinder interacts between the annual report and its quarterly report is that we pay as much attention to de jure developments and de facto developments as we do to policies. Right? Policy developments are critical for contextualizing the choices governments make, not just the data that are captured, but also how to understand the decision making. And here is where you can see some volatility in the market being sort of checked, or in some cases disrupted by the choices the state makes. And policies themselves are something that we track in the quarterlies as well. In each chapter of the indicators for each of the 6 clusters, we have a section that really discusses the policies that we assess were really critical for understanding all of these other developments.
And just to your point here, we put up on screen, where you can show this tracking. Yes, China, which we talked about, but then the open economy average, 10, 20, 2021, and there's some backsliding there.
There's a little bit backsliding between 2021 and 2020. And you also see, though, that they tend to move together, right? So the clustering is really important. We see marginal slipping. We don't see major reversals. And certainly when you drill down on the data, and I really recommend that everybody does it, look at each country's performance, right? Not just compare it where the country is against the average or against China, but also where it is against itself.
Thank you, Nargiza, and thanks to you and the team for just this incredible work that I have learned so much from as I've dove into it. So Yang, I want to turn to you. You were in Beijing, you study this, you have perspective on the Chinese economy, and really my fundamental question to you is how this really aligns with your thinking, your understanding of the Chinese economy on any of the particular metrics or just overall.
Well, overall, I've just found all the trends actually agree with my own observations. Over the last 10 years, China's reform has been progressing quite slowly. But I would like to talk about several reasons of why, just on the upfront, why we see China's reform has been kind of progressing slowly. One, first of all, we have to realize that what we call the new era, the Xi Jinping era, is a period of time that has been designed to correct some of the problems, the key problems that have been accumulated over the last 40 years. Okay, so one of them was problems brought by marketization, for example, income inequality, corruption, all sorts of things. So the current period is deliberately designed to correct those problems. Anti-corruption drive, and also the proposal to increase common prosperity. Now, those campaigns have effects on the indicators of marketization. The second one is to stop so-called chaotic marketization, particularly in the financial sector. Financial reform progressed quite dramatically in several years, just after 2010. But there were a lot of problems. So over the last several years, the government has done quite a lot to change this chaotic marketization. I'm not commenting on the results of those campaigns, but we're just talking about the causes, all right? So the third factor is changing international environment, particularly when the U.S. changed its course over China, particularly in the area of technology. So China respond to that. Last one was correction on some of the policy mistakes. For example, in 2015, China liberalized the formation of the exchange rate. I mean, in that year, it was pretty much like this year. The dollar was rising and RMB was under pressure of depreciation. But then we liberalized the exchange rate regime. So there was a huge devaluation, and then there was a huge outflow of capital. So the government imposed capital control again. And so that's actually related to one of or two of the indicators in the chart. That's direct investment and portfolio investment, right? So there was regression. And again, the regression was very much caused by policies on outbound investment, not on inbound investment, right? Pretty much because of the mistake we made in 2015. I'm not sure if that's permanent or just for the correction. Right? So after the economy is stabilized, probably authority is going to lift those restrictions again. So overall, I feel strongly agreeable with the results of the study. There are some reasons behind.
Yang, thank you. It's important context and perspective on the reasons that lead to the results that we see. And I want to pick up on something you said about permanent or temporary and turn to Sofia, because none of this is happening in a vacuum. We are about to head into the Party Congress in a week, a major domestic and international event. And I think to Yang's point, and my question to you is, would we expect to see any changes in policy either during or coming out of the Party Congress based on what we've seen during the pandemic and maybe shifts as we get on the other end of it?
It's interesting to me because there's an enormous amount of hope that China will pivot into a kind of focusing on growth stage. As was discussed just now, it has been 2 years of course correction, really targeting all the problems that came from marketization, from the very, very quick marketization of China, not China's financial markets, but also Chinese companies. We talked about the competition in the market. There were duopolies. China basically had 2 companies controlling the majority of its tech sector. So correcting that, the problem there and what really shocked people outside China was that how quick it was, how sudden it was, how Xi Jinping did it all at once. And really there was a misunderstanding as to what the context and the purpose of all this was. Now, I would say this is permanent. This is not something that suddenly is going to change after the Party Congress, when the focus right now has been on security and on stability. For the government, this was meant to be the year for stability. It's been anything but that. A lot of that obviously has to do with things beyond China's control. Nobody could have anticipated the war in Ukraine and the strengthening of the dollar, really making it very incredibly difficult for any emerging market to really focus on their own policies. But I think this idea that this kind of misplaced hope that a lot of people have, that after the Party Congress, we'll get that shift back to pragmatism, that shift back to economic growth at all costs. That's not going to happen. The Xi era is very much here to stay. Everyone knows that Xi is going to secure a 3rd term as president. That's very much baked in. For me as a journalist, because China policymaking is so opaque, completely different to what you're used to here in Washington, we try to read the signs, and the signs very much indicate that we're not going to get a zero COVID pivot right now. Most expectations are for March 2023 at the earliest, and it will be slow. It will be a lot slower than we experienced in Hong Kong. The property market, that is something that is it's not accidental. It's a deliberate restructuring of a very problematic part of China's economic growth. It's a bubble. China's trying to do something that no government has ever done successfully, which is to pop a bubble without destabilizing the financial system. Again, I'm not commenting on the results, but let's see what happens there. And also really to set the economy up for a more sustainable path, more sustainable growth going forward. And I think what a lot of people didn't understand is, why is China, the economic growth target for this year was set at 5.5%. Why is China okay, or why is China accepting of a lower growth rate when it has all these levers it can pull to really accelerate the growth rate, to make the economy grow faster? Why is Xi Jinping not doing that? And the answer is really because this is a deliberate way to make economic growth going forward in the next 5 years, the next 10 years. The Communist Party thinks in decades, not in election cycles, a lot more sustainable than it has been.
Well, thank you for that, and thank you for your guidance on what to expect or not expect coming out of the Party Congress next week. I think that's very helpful for us. Dan, Sofia just talked a lot about growth and sustainable growth, which is really a prime motivation for the China Pathfinder project, because the sort of thesis here is that if you can look at reform or lack of reform, you can anticipate future growth potential. That is sort of the idea behind China Pathfinder. And I'm wondering, based on what we see here, based on what Sofia said, is that still an accurate proposition? And while you answer that, I'm going to put up on screen the latest growth forecast. And we just got the WEO update this morning for China, which I think had a slight downgrade, but probably around 4.4% for Chinese growth. So I'll put that up for you.
Great, Josh, thank you. And terrific comments across the panel here. I would say this, that when you look beyond, like when we do near-term growth projecting, like for next year, we ask ourselves, will zero COVID be put to bed, finished up, sufficient to allow a consumption rebound? So we look at near-term consumption potential in the system. But when we look to the long term, the factors that matter most are the return on business investment. Is it efficient? Is the financial system able to make smart investments? Fewer in property and steel mills, and more in next generation industries that have a lot of growth potential and are underinvested. And a very important part of that longer term story is what we call total factor productivity, looking at how efficient the whole system is, how responsive is government to business needs. And that's where the Pathfinder focus on the overall state of evolution toward market norms is not just a kind of concession to international preferences or anything like that. It is the determinant of whether policymaking in China and the way the economy works at home is productive and efficient or not. Without productivity in China's home system, it's going to be very hard for long-run potential growth to exceed, say, 3%, really, which is dramatically lower than leaders in China, and for that matter, even our friends at the IMF and elsewhere, are expecting for China in the 5, 7, 10 years ahead. Those are very low numbers. And when we look at the projections for next year that IMF, World Bank, Bloomberg median survey results all suggest, this year in 2022, since 9 months ago, everyone's 2022 forecasts have come down, and yet, really, nobody's 2023 forecasts have moved that much, only a tiny, tiny bit, as though all the things we're dealing with right now are kind of short-term cyclical considerations. What Pathfinder is suggesting is that it's a profoundly structural issue that we have here, and especially as you get to middle income level, getting that sort of broad reform work done is a necessary sort of linchpin for assuring tomorrow's growth potential.
So I think it's a very important point, and this is a classic issue both at the IMF, where I came from, and then other forecasting. You're assessing the short term, but then your medium-term forecasts are not changing and baking in what's obviously happening in the short term. And again, we just saw the revision out of the IMF, which I think was a 0.1 or a 0.2 downgrade for China, so very small in the broad scheme of things. But Nargiza, I want to turn back to you. I also want to encourage our audience to ask questions. We're getting a lot of questions online. Please submit them if you're watching on Zoom or if you're watching on Twitter, and we'll ask our panel. But Nargiza, Dan talked about some of the really problematic implications for China, absent reform, absent a change in policy. But China Pathfinder has positives for China as well, and I think it's important to talk about that. Dan and I spoke about trade a little bit. There's interesting news on innovation, so I wanted to tee that up for you.
So the trade story is kind of an interesting situation because it is absolutely the bright spot for China. And it's also a bit of a double-edged sword, right? And the question here is sort of what kind of growth, what kind of an economy does China want? We unpack China's growth, we look at investment, we look at consumption, which are not doing well. And so it's sort of net exports, right? This continued reliance on the surge of demand for China's goods. That is sort of the only hope to try to rescue the economy. And here is where we start running into problems, right? Certainly, what happens in world trade is not up to China alone, so they would like to find opportunities for new markets, but we also know that the global economy is not as healthy as it would like to be. We certainly know also that a lot of China's trading partners are quite unhappy with the sort of deterioration of the trade balance they've seen over the course of the pandemic in the early stages of a massive surge of Chinese goods going all over the world. But then we see the impact of zero COVID on production. We see the sort of the rising tension over dependencies, and every single European country has seen its trade balance with China deteriorating, with the exception of Luxembourg. So they're not looking forward to buying more, and it's certainly true that the inflation has taken a bite out of people's ability to buy more and more things, right? So all of these things together are acting as sort of as a damper on sort of the possibility that China could surge out and sort of see its growth renewed through more exports. And actually, Chinese government officials are quite clear-eyed about that. They've come out with statements saying that it's going to be very difficult for China's exports in 2023 to try to continue enjoying the same kind of growth. I think an important consideration, going back to the point I made earlier, what kind of growth does China want? China's leaders have talked a lot about wanting to transition to more sustainable growth, to more consumption-driven growth, right? And going back to the same kind of export-driven stimulus to the economy is not going to get you there.
So that's perfect transition to Yang. What I want to ask you, because building off of what Nargiza said, if we think about it, we have this premise of China Pathfinder that a lot of what we're seeing is maybe problematic, that there's regression or there's stagnation and there's not movement to open market economy. But my question to you, Yang, and building off what Nargiza said, is that actually a problem? Has China's economy, which has grown so much domestically, think differently? Does the leadership think differently? Does the party think differently about how to drive growth, where what was stated earlier about the need for open market reforms isn't as true anymore if it is to achieve medium or long-term sustainable growth?
To me, I don't think that in the long run or in the medium run, China's economy has any problem. China's economy itself has a lot of potential, right? And so then talk about TLP. I really don't think, I'm an economist, but I really don't believe in the results provided by economists for TLP, right? So you look at China's R&D investment over the last 10 years, it increased dramatically. Now it's the second largest in the world, 2/3 of American level. Of course, there are risks in the economy, but with this tremendous growth, there must be some effects. And my own experience visiting all the companies led me to believe that at the grassroots level, China's economy still has lots of potential, right? I think the problem that we have today are more cyclical than structural, right? It's very much related to zero COVID policy and also the government's intention to correct the property markets. As soon as we finish those policies, our economy is going to grow again. My calculation for China's potential growth rate is still around 5.5. Right? And so depending how you estimate TLP, but even just with capital accumulation, China can get 3.8% growth annually, and then adding TLP growth 20% or to 40% the total growth. Then we're going to come to the average number around 5.5. So that's my estimate. Right? So I tend to agree with Sofia's estimate. Right? So most of the policies that we see today from the governments are intended to correct some of the problems that the leaders believe hindrance for China's future growth.
Yang, thank you. And I think what you said is really maybe core to both the current and the ongoing ambition of Pathfinder, which is cyclical versus structural. And 2023 and 2024, this is a 4-year study, we're in year 2, is going to help answer that question. So we will invite you back, Yang, to assess that prediction in a year. Sophia, I want to turn to you on markets. You do such a service to the whole world who follow your updates weekly on what's happened in China's economy, what's happened in China's markets. Does what we show on portfolio investment openness, this basic no movement since 2010, how does that align with what you see in the markets day to day, studying this and working on this?
I think there's an important distinction, which is the inbound and outbound portfolio investment. And also this year has really kind of reinforced the point that having a very open capital account would be a dangerous thing for China. You're seeing how much money is being pulled out of more open emerging markets that have that dependency on the dollar economy. And China is the only country in the world that's not going through that right now. So, the amount of capital leaving China, the idea that China will open up its capital borders and allow as much renminbi as anyone wants to leave the country, I think that won't happen. That won't happen anytime soon. And also, importantly, during the pandemic, what you did see was the creation of bubbles in China. I mean, the yuan was incredibly strong because of the demand for Chinese exports. But also, you saw, as early as January 2020, I remember I was writing about this. Yao Yang, the governor of the PBOC, said what the Fed is doing is pumping so much money into the international financial system and creating all these bubbles. We're going to have problems down the line. So that kind of mentality is why China has such a problematic, has such a difficult relationship, I should say, with capital flows, because it's not just the capital that can flow out of its domestic markets, but it's also the global capital that can go in and create these bubbles that China is already trying to correct. I mean, the property market is one, but you also had the stock market in 2015. I mean, that was a huge bubble, and that had a lot to do with the amount of capital that could go in, and then the speculation that was kind of reinforced by that domestically. So, again, I'm not surprised by the lack of progress. I think there's a lot of appetite for China to open up portfolio investment, at least from people I talked to I was in Europe over the summer, people I talked to in Europe, people I talked to here. The Swaps Connect that's being introduced, the ETF Connect that was introduced this year, those are two things that showed some progress in that China does want global capital to invest in its domestic financial markets. We had this debate this year that China was uninvestable. So then you kind of fall into the kind of narrative that does global capital still want to go into China? Has something changed in the past 2 years? Has global investor trust of policymaking in China been really damaged by what happened in the past 2 years? And that's, I think, a question that can be answered next year when you do have the normalization of the economy and hopefully zero COVID being put to bed, like Dan said.
Yeah, that is a key question, and you're right to point out some of the moves that have been made a little bit, under the radar from our perspective in Washington on moves to open up and set themselves up post-COVID or post-zero COVID policy. I want to just ask a follow-up because we have a lot of questions. You mentioned strong dollar, you mentioned PBOC. PBOC reaction to the strong dollar. I mean, this is going to be a big theme at IMF week. Emerging markets EMs coming to Jay Powell and the Fed and saying, you are creating enormous pressures on our economy with this strong dollar. How is the PBOC addressing that kind of challenge, and what might we see in the coming months?
So we've seen the PBOC, compared to all other central banks in Asia, I mean, you saw direct intervention in India, in Korea, in Taiwan, and in Japan, obviously. The PBOC has refrained from really intervening very strongly in the currency market. It wants to let the the currency market be driven by market forces. And this is very much something that it wants to represent to international investors, that it's not going to meddle in markets. Obviously, the yuan is a tightly managed currency. It can only move 2% either way of a daily fixing that's set every morning. And that's also been changed. The PBOC has been setting stronger fixings. It really wants to make sure that the currency doesn't depreciate too quickly. But importantly, we look at dollar yuan, and obviously dollar yuan, the yuan hit the weakest since 2008 last month. But versus the euro, versus the yen, these are important trading partners for China. The yuan is incredibly strong versus the pound, obviously. So managed weakness is something that the PBOC wants to see, but no one-way movements, no speculation. And actually, if you use the Bloomberg terminal and you look at the derivatives market, you look at positioning, there doesn't actually seem to be a very strong bets by short sellers, by hedge funds against the currency, and that's what the PBOC wants. It doesn't want the currency to weaken too quickly, but it will tolerate currency weakness.
And it's been, the PBOC's kind of been in a different place than most central banks during this tightening cycle. There's different approach to it. And it sounds like from what you're saying, we shouldn't expect any major shifts in the next few months, different from what we've seen already from the PBOC.
It's cut interest rates, but some people say it cut interest rates far too late. Yeah. It's injected liquidity into the financial system. So yes, it's the only major economy that's actually loosening policy. Right. You can argue that the UK started loosening policy abruptly. Right. But that's a different conversation. Yeah. But yes, it's going in the complete opposite direction to the most of the world. But big stimulus, the kind of big bazooka that we saw in 2015. Sorry, not 2015. In the aftermath of the global financial crisis in 2008, 2009. That's incredibly unlikely because that's what created China's problems. And that's the hangover that policymakers are dealing with now. So it will be very calibrated, be very careful. China has criticized what the Fed's done. I mean, the comments that, very, very public comments from Yang and the CSRC as well, the securities regulator, during the pandemic, during 2020 and 2021, that what the Fed was doing was excessive. What the central banks in Europe were doing was too much, that inflation was going to be a problem. Had we listened, so this kind of monetary policy excess, we're not going to get from China.
Thank you. Okay, so we have about 15 minutes left. I'm going to turn to audience questions, but before I do, Dan, I just have to ask you to respond to Yang's point, cyclical versus structural, because I think this is so fundamental, how you see it, not that you have to have a definitive answer one way or the other.
Yeah. Well, I mean, there are both sorts of policy challenges confronting Beijing today. Policymakers in Beijing have dealt with all sorts of cyclical shocks over the years. Ultimately, I think they get generally a pretty good report card for their ability to handle all the various cyclical challenges that come up along the way. What's different this time is that there are profoundly structural headwinds here layered on top of the kinds of cyclical things that are going to necessarily come up for all economies. And first and foremost, that is that the swelling of the property sector alone to as much as a quarter of total GDP of the country as an engine of growth in the numbers. I mean, Yang's right, the savings pool is there in China to do big things and to generate a lot of growth, but it won't have as sustainable a life in some sectors as it will in others. And in the biggest sector of all, property, we've kind of gotten to the end of the line in terms of activity as we've known it. And so somehow we have this structural problem that we need to re-intermediate where capital is going and why it goes there and the incentives that help determine where it flows. And we don't really have a full package of central answers to the question of how we're going to end the property crisis right now. We have some intermediate steps, some temporary steps that have been taken, but we don't know what the overall package is going to be that's going to resolve how the losses are going to be shared for the overinvestment in property that has been the past 10 years of Chinese economic activity. I agree with Yang that, and Sofia, I think as well, that once stability is re-established in the Chinese system, we've got years of pretty strong growth potential ahead of us. The problem is that first step of getting to a new, normal, stable set of conditions. We have a lot of very, very big risks between where we are today and getting to that point.
And the post-pandemic stability, what that looks like, will be somewhat structurally different than the pre-pandemic. I mean, property sector we talked about.
Yeah.
Zero
growth as
policies.
we've known it is not coming back. There's never going to be a China growth equation that has as much property sector activity as there has been. Likewise, and we got into this a little bit, the role, and Nargiza mentioned it, the role of net exports in the Chinese GDP numbers in recent years has been atypical and should not be expected to continue into the future just because the rest of the world is getting back on its feet. Even a very strong dollar this year has not been able to add to China's exports to the United States, really. We're at the peak there. And so those are structural
global
changes.
recession is not going to do any favors.
Certainly not going to help, right? So there are structural changes necessary in where China's growth is going to come from. I'm still pretty bullish about the potential. I do think there's the chance for a surprising amount of reorientation back toward market reform work after the Congress, probably not before the National People's Congress in the spring, so I'm in agreement there. But there's really no way forward that does not entail using market signals and logic to help get back to China's potential growth.
So we've talked about property sector, we talked about zero COVID, but there's another issue, and we have quite a few questions about this, and Nargiza, I'll turn to you, and it's tech sector. Crackdown on tech companies. Sofia alluded to this a little in her comments about two major fintech companies controlling, I think we estimate 95% of payments in the country. How do we, from Pathfinder, incorporate that? That's the question we have here. Is it in the innovation measurement where we start looking at that? How does what's happening in the tech sector get factored into the China Pathfinder project?
So we tackle it from multiple directions, and it's really not surprising for most modern economies that are also sort of global players. Technology cuts across multiple indicators, right? In fact, the tech crackdown, the zero COVID policy, and the distress in the real estate sector are three bands that really cut across all of the indicators for China because they're so important. It speaks to not just policy intention with regard to those specific companies, but also for what the vision is by the government for the sector, the bigger cluster, and then big existential questions about things like investability and the role of innovation and private enterprise in China's economy, right? An important fact that I really like to point to is the way that the stress in the tech sector has really translated into employment statistics, which is really important. China's young youth unemployment has been very high. And historically, the tech sector has actually been a major employer for those graduates, right? So it's not just a question about innovation and technology per se, it's also a question of social stability. And again, what kind of a growth, what kind of a future China looks forward to. It also speaks to an important dynamic, which is it's not all about China. Other economies, other governments, other companies are observing what's happening in China. And we already know that in the United States, in Europe, and elsewhere, many developed economies are contemplating the policies that the Chinese government has introduced in its tech sector. And they are concerned about data privacy. They're concerned about technology and innovation competitiveness. We've seen the Biden administration come out strongly with a package of new restrictions because of the concerns of what the Chinese government envisions for technology innovation competition and how to manage that.
Yeah, no, it's such a good point because, and we were speaking about this, Dan, yesterday, we think of how China thinks the West is approaching it, or the other open market economies in terms of tech and innovation, and then those economies themselves, I think maybe fulfilling some of China's skepticism or fear about and why they built some self-sufficiency in the system over the past several years.
And I know that Yang has some strong points of view about this as well. He's made the argument, we've had this discussion, that a lot of that regulatory campaign in China with regard to the tech sector has been to deal with the overconcentration of market power and necessary sort of cleaning up sort of some of the side effects of the past decade of very fast Chinese development and growth, especially in high technology. So I'm curious what Yang thinks about that question as well.
Yang, I'll turn to you on the tech sector, and I'll also add on something we got for you, which is about demographics. Nargiza talked about youth unemployment, but then there's also the other side of the demographic spectrum and how that weighs on China's medium and long-term growth potential.
Well, I think there were two issues to the tech sector. One, as Dan said, they are too big. They are so big that their influence is everywhere, is actually beyond the economic arena. So that's actually, I think, a problem, not just in China, but also in the US and also in Europe. And Europe has also taken some measures to curb the influence of those so-called platform companies, all right? So that's one. Second was the data security issue, particularly in the case of DD. I think that's a real concern, not just in China, but also in the United States, right? But after the campaign, I believe now the regulators have realized that we cannot use a campaign to regulate the high-tech sector. So the situation is more or less on a track to normality. Now the issues we are discussing in China are pretty much the issues discussed elsewhere, particularly in Europe. For example, the property rights of data, how we are going to protect the privacy of data, how to use data provided by individuals. So there is a convergence in the regulatory framework.
Thank you, Yang. Sofia, I want to turn a question we have for you, perspective from Hong Kong, which the question is very simple. What is Hong Kong's future as an international financial center? You could have predicted that that question was going to come in.
Very simple question, very complicated answer.
So just, take whatever time you need to answer that.
So we were actually talking about this before we started the panel, that Hong Kong is really positioning itself as the gateway into China, because that's the one thing that no other rival like Singapore can replace it. So, I mean, the problem with Hong Kong is that the border to mainland China is still shut. So the fact that it's positioning itself like that, but people can't freely travel to the mainland, has been problematic for that narrative. How can you be a gateway, the world's gateway into China, when borders are shut to the world, but also to China? So Hong Kong needs to position itself like that, and it needs to do so quickly. John Lee, the new chief executive, has a policy address next week where he is expected to roll out what's to come for Hong Kong. We know that financially and economically, the city is under severe trouble. I mean, not just the amount of capital that's left Hong Kong. Obviously, Hong Kong, unlike China, has a open capital borders. Capital does flow in and out. We do have the dollar peg, which makes things a little bit more stable. But the outflow of people, the human capital that's left Hong Kong, has been so severe this year, and the numbers are staggering. And it's not just people who left temporarily to move to Singapore to work from home, from Europe or from the US, but people that just lost faith in Hong Kong's future. There's obviously been a multi-year build-up to that. It's not just COVID. It's also obviously 2019 protests. That was a very difficult time for Hong Kong, and the 2020 national security law that was imposed in the middle of COVID. That, yes, it brought stability. It brought much-needed stability to Hong Kong. And when I say that to people in Hong Kong, they look at me, why are you saying that? It's a controversial statement to make. Yes, it did bring stability, but it also made people rethink how they see Hong Kong and its future as an international financial center. Does it mean that it will just be another Chinese city? Does it mean that Hong Kong will be what Shanghai was trying to be, which is the financial capital of Greater China? Or will it be a global financial center like New York or London? And that's kind of the existential crisis. I mean, this year was the 25th anniversary of the handover. We're halfway through what was meant to be a 50-year transition period. And many commentators are saying that Hong Kong is a lot closer to what was meant to happen at the end of that 50-year period than in the middle. So the question is, can Hong Kong survive as an international financial center if it positions itself as a gateway into a very different China? I would say yes, because there's an incredible amount of interest still in China.
Nargiza, Dan, I think we need a Hong Kong Pathfinder. There's so much to unpack about Hong Kong's financial system, related and interconnected, but also separate from the broader Chinese financial system. Nargiza, question for you on the methodology of the report, which is great that people are diving into it and asking questions.
Please, we want them to.
Which is about, one of the things I love about Pathfinder is that some of the findings are counterintuitive to people in Washington who maybe don't follow the Chinese economy very closely. Trade is one, some of the innovation statistics, and this question's about Belt and Road. And okay, so we think about all of China's investments and discussion about all of China's investments overseas. Where does that factor in to the study? How does Belt and Road and foreign investments and foreign direct investments factor into our calculations?
So I'm very glad that came up, because this is another opportunity for a small corrective, right? Because Belt and Road is mostly a loan story, less an investment story.
Yeah.
That said, there is obviously capital that flows along sort of traditional FDI channels, and when it does, that gets captured in our assessment of China's outward FDI intensity, for example. On the loans question itself, so it's not something that we capture by the China Pathfinder research framework. But when we see sort of a lot of the questions about BRI, everyone looks at the official data and sort of wants to see a flowering of foreign direct investment. Most foreign direct investment from China continues to flow to the destinations you would expect: the United States, Europe, wealthy economies. Hong Kong is a nominally major investor in China, right? Because it's so much capital gets channeled through Hong Kong, and including round-tripping flows. So the official stats don't really capture a lot of the nuance and the texture in how capital enters China or how it exits it.
So one follow-up for you, and then I'm going to do a final round with everyone. But another methodological question, which is about how we determine in the study breakdown between state-owned enterprises, not state-owned enterprises, what is private, what is public. Obviously so complicated to do in China. And if you could discuss just for a minute how the research team approaches that challenge.
So this is a really important factor to consider, and we have a fairly extensive methodological discussion in the report, which I really encourage everyone to take a look at. But at the most fundamental level, most kind of existing indices for state ownership take a kind of a value-neutral approach. A French SOE is just like a Chinese SOE from that regard. And we don't think that's quite true. It doesn't really capture the role of the state in China's economy, which can be extensive. It can really tilt the scales in many regards. And so in our market competition cluster in particular, we really engage with the role of SOEs, and we actually manually collected ownership information to make sure that we capture exactly who owns this company. And if it's direct ownership or indirect ownership, to really try to take that into account. That said, it is not perfect. We know that the state actually has a much greater role in the economy than we can capture with just numbers alone. This is true for the innovation assessments as well. When we look at, another counterintuitive finding, perhaps when we look at the role of private R&D in China's economy, it's very high. Well, that is because a lot of the ways that the state supports innovation in China, like government guidance funds, like various kinds of subsidies, are not really transparent. And therefore, they really skew the distribution.
That private R&D chart that is worth everyone looking at because it jumps out at you.
Right.
You look at it and it's important to unpack the nuance. Yang, we just got a question in on my favorite topic, so I have to turn to you on it. No one here is going to be surprised what this is. And then I'm going to turn to the panel for final comments, which is about Pathfinder 2023. So just so everyone can start preparing. But it's about ECNY. China's digital currency, and I think the question probably conflates two things, and I'd be curious for your view on both. First is the role of ECNY in the domestic economy, retail. But I think what's more interesting for our purposes in China Pathfinder and portfolio investment is wholesale, cross-border, bank-to-bank settlement. We know there was a major test last week with the Bank for International Settlements where China settled $22 million cross-border with the UAE and Thailand. And so this question is about wholesale central bank digital currency cross-border and what it could mean for China opening up maybe outside a direct dollar-based system in the future.
Well, I don't think so. You know, e-currency is just about technology, and money is just money, right? The most important thing is still the border control of the capital account, right? So even if China established kind of an e-currency settlement system, we still need other countries to trust RMB and to use RMB.
Yeah.
That's actually an economic issue. That's not a technology issue. Even inside China, I don't think the e-money issued by our central bank is widely used. We still use, Alipay or which is Tencent Pay. I don't have any friend who is using the central bank e-money. So there's a long way to go.
I'm so glad you said that. And to our audience listening in Washington, which talks a lot about ECNY, I think that's an important message for them to hear. So Sofia, I'll turn to you first for closing thoughts. And it's really the question I'm going to ask the whole panel to wrap up, which is, what do you think China Pathfinder 2023 might look like, either in any particular dimension on markets, portfolio investment, or just the broad scale when we do this dashboard a year from now?
If I could ask if there is a way to capture confidence, that's one thing that I think is the key to China's growth going forward. I mean, we talked about productivity, unemployment, the housing market, consumption. All of that you can link in with confidence. If there's a way that Nargiza can figure out how to kind of model this, then
the research team sweating.
I think it will show. It will reflect what happened this year, and what happened this year is China looked inwards. China, what I was talking to one of my editors this week about was China is hunkering down. It's really focusing on its domestic markets. The global international environment is increasingly hostile to China. The CHIPS Act and what Biden's doing on that front is incredibly painful for Chinese companies. So if you look at the strength of domestic markets, 90% of Chinese IPOs were raised onshore. That's a record. That's the highest proportion since 1999. An enormous amount of money was raised in onshore markets. The debt market onshore is much, much stronger than the offshore market, which has seen record defaults. So that kind of shift that China has seen inwards, I think would be really visible on the markets front.
Okay, that's good guidance for us going into the 2023 project. Yang, I'll turn to you. Your thoughts about what we should be looking at in the year ahead as we embark on the next year of this study.
Well, I think one is the comparison between the United States and China in terms of industrial policy. So Dan said, in the U.S. There is kind of a coming back the market competition. For academic economists, that's a new development. Is there a trend for the two countries to converge to the same level of industrial policy? I think that's very interesting to find out.
If that showed up in China Pathfinder, I think we would capture a lot of attention in both capitals. Dan, your thoughts as we close the chapter on this year and embark on the next year?
Well, I think, in my opinion, the question of our times here is going to be, what is the diagnosis for the structural Chinese slowdown? I think, yes, there are cyclical factors, but I think the larger picture of the challenge Beijing has had stimulating its way through the extent of the downturn this year, which if they could have, they would have turned in a better result closer to their growth target than they will, right? That's not going to be resolved next year, even with the end of COVID policies. These structural headwinds are going to continue to weigh on the system. And the big question will be, how do people interpret that? How do policymakers in China and around the world understand that? If they understand it as the need to catch up on getting some of these basic market reforms done, reforms which in the past were not thought of as ideological at all. They were a shared set of goals that both leaders in China, Zhirongji comes to mind, and leaders in the West espoused as the right way to make sure that you were sustainable and prosperous as an economy. If we have a coming back together around that basic diagnosis, then we have a lot of potential to protect engagement against the calls for decoupling that persist. And if we do want to go that way, Pathfinder is going to offer the playbook for where we need to focus our attention.
Okay, that's an optimistic note. Nargiza, I'll give you the last word.
I think just to respond to this idea of confidence, I think that's really critical, right? The way that investors look at the economy, where they choose to invest, is very meaningful. But it's not just external. I think we really have to look at what China's domestic companies are doing, what China's households are doing. And we know Chinese households have been so damped down by the pandemic. Zero COVID has really had a tremendous impact on their ability to consume. And that's really critical. Where people feel confidence in the economy, they buy things, they seek employment. We've seen a sort of a major kind of retreat to state-owned enterprise, seeking employment for people because they've sort of lost confidence in being able to find this employment in the private sector. I think that's very meaningful. Looking at how China's economy begins to emerge, if it begins to emerge out of the current level of restriction, is going to be very meaningful. Any kind of directionality, ideological or policy-driven, is going to be met with sort of very hard reality of what is actually possible to do under conditions of continued lockdown or sort of consumption suppression that we've witnessed. I think the other item that will be really interesting to observe is what China does with regard to its external environment. And this may seem like a very obvious statement, but I think we have to be very careful not to assume that everything China does is in response to what everybody else does, right? That really reduces sort of the autonomy and the real ownership that Chinese leaders take when they make policy decisions. How China chooses to engage with the world is going to be up to China's leaders. And that is also going to, in turn, shape how the rest of the world engages with China.
Nargiza, thank you. Yang, Sofia, Dan, Nargiza, thank you for being with us. Thank you for the partnership with Rodium Group that has led to this report. I want to thank everyone who's joined us today, and I have to give a few thank yous by name to the research team and all those who supported this project. So bear with us a second, but they worked so hard over a year to put this together. So Rachel Litzau, Ryan Featherston, Baoyan Chen, Nancy Messier, Niels Graham from our team at the Atlantic Council here, Miles Munkasey, and I want to thank the Advisory Council of the China Pathfinder Project, Gary Rochelle, Stephen Denning, Jack Wadsworth, everyone at Rodium Group and Atlantic Council who've been part of this. This is year 2 of 4. So we are going to keep doing this. We think it's important work. We think we can learn something both about the Chinese economy and the US economy as we do it. So please stay with us at the Atlantic Council. We have a busy week ahead for IMF week. A finance minister is coming into town for public events. We hope you can join. Tomorrow we do a session on the IMF's World Economic Outlook. Well, certainly China will feature prominently in that. So stay with us. Thank you for being with us. Have a great rest of the day.